Hello crypto friends, welcome to the Inventor Strategy Select channel. Here we focus on sharing mature strategies that have actually run through real market conditions in the crypto space and been validated through live trading, helping you avoid pitfalls and capture more profits. Today we are going to discuss an old problem that many friends encounter in actual trading. How should you set your risk-reward ratio? Many people start by choosing a fixed ratio, like 2 to 1 or 3 to 1, which sounds reasonable. But when you actually run it through different market conditions, the effectiveness starts to diminish. Let me give you a real example. There was an experienced trader who was still using a fixed 2 to 1 ratio when the bull market came, and as a result, he could not fully capitalize on the main upward wave. Conversely, during sideways markets, he was unwilling to settle and stubbornly stuck with high risk-reward ratios, resulting in frequent stop-loss triggers and consecutive account drawdowns. This is essentially a typical case of strategy not adapting to market conditions. What we are going to discuss today is designed to solve exactly this situation. The Dynamic Risk-Reward SMA ATR strategy. Its core concept is not complicated. It uses SMA moving average crossovers to identify trends, then combines ATR to dynamically adjust your risk-reward ratio. When trends are clear, it amplifies profit targets. During choppy markets, it becomes relatively conservative to improve win rates, truly achieving adapting to market conditions with dynamic balance. The biggest advantage of this strategy is its strong adaptability. Whether you are dealing with bull market main waves or facing sideways consolidation, it can flexibly adjust operational rhythm, seize core opportunities, and avoid unnecessary losses. So let us dive deeper into its actual operational logic and parameter configuration, aiming to help you master this system before the next Bitcoin bull market arrives, so you can put it to use effectively. Imagine you are a driver on a road with constantly changing conditions. On a wide, smooth highway, you speed up. On a rough mountain road, you slow down and drive carefully. The dynamic risk-reward trading strategy works just like this, automatically adjusting to market conditions. It combines a triple SMA system to determine market trend direction, ATR indicator to measure market volatility, and a mechanism that adjusts risk-reward ratios based on moving average crossover signals. When a strong trend signal is detected, the strategy automatically increases the risk-reward ratio from the standard 2 to 1 to 6 to 1, letting profits run and truly hodling the big trend. Stop-loss and take-profit points are dynamically calculated based on ATR perfectly adapting to different coins and timeframes, avoiding bad decisions during market FUD or FOMO. What makes this strategy unique is that it not only tells you when to enter, but also how to set your take-profit and stop-loss based on signal strength, enabling intelligent trading decisions throughout the entire market cycle, from whale accumulation zones to market bubble tops. In any strategy, parameter settings often determine its character. Just like cooking, the same ingredients with different proportions create completely different flavors. For short, medium, and long-term moving averages, we use fixed values of 725 and 99. These parameters align with mainstream exchange cycle definitions, which we will explain in detail in the indicator definition section. Besides these fixed parameters, the strategy's custom parameters include two key values, ATR period and ATR multiplier. The ATR period is set to 14, a classic value that is smooth enough without too much lag, matching most cryptocurrency trading indicator calculation periods. The ATR multiplier directly affects stop-loss distance, with a setting of 1 meaning the stop-loss is placed exactly at 1 ATR distance, precisely measuring digital finance volatility. Too small a multiplier causes frequent stop-losses that get eaten up by exchange transaction fees, while too large might miss opportunities to protect profits. Think about this. If the market suddenly enters a supercycle bull phase, would these fixed parameters still work? This is exactly why the strategy introduces dynamic risk-reward ratios. The core of this strategy is the carefully chosen triple SMA system. Why these specific periods of 725 and 99? There is brilliant market philosophy behind this. The number 7 represents short-term cycles, capturing market sentiment changes and sudden on-chain fund movements. The 25 period reflects medium-term trends and whale accumulation zones, while the 99 period serves as a barometer for long-term big trends. According to cryptocurrency backtesting, combining short and medium-term indicators yields accuracy of only about 60%, but adding the long-term filter increases accuracy to 78%. This whale observation indicator combination is extremely effective. Using multiple timeframes together cleverly solves the problem of single moving average systems struggling to balance timely signals and reliability. The ATR indicator is equally ingenious, not only calculating stop-loss positions, but forming the foundation of the entire risk management system. Why not use fixed points or percentages as stop-loss standards? Because ATR adaptively reflects current market volatility, automatically expanding protection during increased volatility from liquidity mining or yield farming, or when Trump stirs up market turbulence with a tweet, while precisely controlling risk when volatility contracts. The strategy conditions define the exact timing for entry, like a hunter's scope determining when to pull the trigger. Long conditions require the 7-period SMA to cross above the 25-period SMA, while the closing price must be above the 99-period SMA. This double confirmation greatly improves signal quality. The first captures medium to short-term momentum changes, while the second ensures big trend support. During cryptocurrency bull market cycles, this condition is especially effective because it precisely captures rebound opportunities when prices pull back near major trend support levels, avoiding wrong decisions influenced by market FUD sentiment. Conversely, short conditions occur when the 7-period SMA crosses below the 25-period SMA, and the closing price is below the 99-period SMA, following the basic rules of trend trading and effectively identifying shorting opportunities during bear market rallies. Notably, the strategy defines two types of crossovers, one between the 7-period and 99-period SMAs, and another between the 7-period and 25-period SMAs. These crossover signals have different strengths. The former indicates major shifts between short and long-term trends, while the latter shows changes in medium to short-term momentum. Imagine if the short-term average crosses both medium and long-term averages simultaneously. What does this suggest? Clearly, it is a stronger trend change signal, possibly the beginning of a market cycle turning point or liquidity event, deserving a larger profit target. This forms the basis for the strategy's risk-reward ratio adjustments, giving traders a perspective similar to whale investors. The signal generation phase is the most innovative part of the strategy, automatically adjusting risk-reward ratios based on crossover signal strength. By default, the strategy uses a 2 risk-reward ratio, a classic trading configuration meaning for every 1 unit of risk taken, 2 units of return are expected. However, when the strategy detects special crossover signals, the risk-reward ratio automatically increases to 6, entering super hodl mode. This dynamic adjustment mechanism is the strategy's masterstroke. In cryptocurrency markets, there is a phenomenon called trend acceleration. When short-term averages cross both medium and long-term averages simultaneously, it often indicates a strong trend formation, possibly signaling on-chain fund inflows or institutional bottom buying. An on-chain analyst once shared a case where Ethereum transitioned from consolidation to an uptrend, with the 7-day average crossing above both 25 and 99-day averages. On-chain transaction data showed large funds moving from exchanges to private wallets. Using only a 2-to-1 risk-reward ratio would have exited at a 30% gain, but the actual rise exceeded 120%. The strategy captures this pattern, significantly increasing profit targets when special signals appear. Why choose 6-to-1 rather than other ratios? This is an empirical value based on measuring the average movement amplitude after crypto market trends form, specifically corresponding to typical multiples and single trend cycles in cryptocurrency markets, neither too conservative to miss big moves nor too aggressive to be unachievable. In the strategy execution section, the code implements a complete trading process. When long conditions are met, the system issues a buy command. Similarly, when short conditions are met, it issues a sell signal to open a short position. Notice the use of the strategy entry function, which automatically handles position management, ensuring no repeated entries when positions already exist, avoiding unnecessary transaction fee expenses. But the real highlight of the strategy is its exit mechanism. Each trade comes with 2 exit methods, stop loss and take profit. For long trades, the stop loss is set at the current low -1 ATR, precisely measuring downside risk, while take profit is set at the current closing price, plus ATR multiplied by the risk-reward ratio, letting profits run during bull market cycles. Short trades use the opposite logic. This ATR-based dynamic stop-loss and take-profit mechanism allows the strategy to automatically adjust exit points based on actual market volatility, rather than using rigid fixed percentages. In cryptocurrency markets, different coins have vastly different volatility characteristics. Bitcoin's daily volatility might be 2 to 5%, while some small-cap coins might reach 20 to 30%, and on-chain liquidity mining activities can cause volatility spikes. Using a uniform fixed percentage stop-loss obviously cannot adapt to these differences. ATR as a volatility indicator naturally has the ability to adapt to different asset characteristics, providing a universal risk management framework for the strategy. This exit method ensures capturing enough profit when markets move favorably while promptly protecting capital during trend reversals, avoiding becoming victims of whale dumps. The suitable environment for this strategy is very clear. In bull markets with clear uptrends, signals where short-period averages cross above long-period averages are especially effective. The strategy automatically adjusts the risk-reward ratio to 6-to-1, letting profits run and avoiding premature exits that miss explosive opportunities. A typical case is Binance Coin BNB. In the early bull market of late 2020, where after short-term averages crossed above long-term averages, the price increased nearly 5 times in 60 days with continuous liquidity inflow. The strategy's 6-to-1 risk-reward ratio perfectly captured most of this rise. In contrast, during bear markets, the strategy's short signals often capture the beginning of sharp declines, especially when short-term averages cross below long-term averages and prices break below long-term support, often signaling the start of liquidity crises. However, in choppy markets, frequent moving average crossovers may generate too many false signals. In these conditions, the default 2-to-1 risk-reward ratio effectively controls losses, preventing excessive positions from being eroded by high transaction fees. A common misconception is blindly pursuing high risk-reward ratios. Some traders, influenced by FOMO, adjust all signals to 6-to-1 risk-reward ratios, only to find that almost no trades reach take-profit levels in choppy markets. The correct approach is to respect the strategy's signal differentiation mechanism, letting the system automatically adjust based on market conditions. Advanced users might consider matching ATR periods with moving average periods, such as using longer ATR periods on higher time frames to filter noise. You can also combine momentum indicators like RSI, only trading in RSI-confirmed directions to further improve win rates, especially in avoiding liquidity traps. As a quantitative analyst evaluating this strategy, I have found both impressive highlights and notable limitations. The strategy includes complete entry, risk management, and exit mechanisms, forming a closed-loop trading system, but lacks position sizing components that could adjust position size based on signal strength or implement DCA strategies for staged entries. Risk management performs excellently by dynamically adjusting stop-loss positions through ATR and intelligently varying risk-reward ratios based on signal strength, but may result in overly wide stops during extreme market volatility or flash crashes, and does not address high transaction fee environments. For adaptability, the strategy can be applied to various cryptocurrencies and timeframes, especially excelling at capturing market cycle transition points, but underperforms in sideways choppy markets, generating false signals and responding inadequately to on-chain liquidity events. Understandability is very high, using mainstream technical indicators with clear, intuitive logic that even crypto trading beginners can easily grasp. Innovation is somewhat limited, as SMA7 and ATR stops are traditional technical analysis methods. While the dynamic risk-reward ratio design is creative, it lacks integration with fundamental data, giving it limited overall innovation. Practicality performs well, with simple parameters requiring infrequent adjustment, suitable for live trading on both DEX and TEX, though traders need patience to wait for high-quality signals and avoid overtrading. Overall, this is a balanced and practical strategy, particularly suitable for hodl traders looking to capture major opportunities in cryptocurrency trend markets. Not every strategy needs to be dazzlingly complex. Sometimes simple yet ingenious designs create excellent results. Thanks for watching. Please like, comment, and share.